for joining us on this web conference discussing the May FOMC meeting, of course, from the Federal Reserve in the US. I'm Ty Huynh, the Chief Market Strategist for APAC at JP Morgan Asset Management. And what I'm going to do over the next 30 minutes or so is really to share with you not only what the Fed did and said last night, but more importantly, what does that mean for investors around Asia Pacific? We do get a lot of questions on a number of hot topics as well, so I'll address those. For example, the risk of a recession in the US. What does that mean for US equities and broader US dollar assets? And of course, the US dollar trends, which we've seen quite a bit of Asian currency strength in the recent past. All the charts you see today do come from our Guide to the Markets Asia, and at the same time, many of these charts we do now update every day. So on the screen right now, you see a couple of QR codes. One is the daily guide. So if you want to get a daily update on some of these charts, that's very much available on the website. We do also run a podcast. We do go through some of the hot topics for APAC investors every week. So this week is going to be very much this particular broadcast on the Fed. Last week, we spoke about the US dollar and its role in the global financial system. And in the next couple of weeks, we will go through, for example, the fixed income world. Where do we think the opportunities and the risks are, as well as for Asian equities? So let's go back to the main event of the day. First of all, I think, well, no surprise, the Fed kept policy was unchanged. As expected, frankly, there was no particularly strong case for the Fed to move. And a lot of the Fed comments in the recent past suggest that they're in no hurry to cut rates. And the reality is, if you look at both the statement and more importantly, Fed Chair Jay Powell's press conference afterwards, I think there are a couple of key takeaways. Number one, the word uncertainty came up a lot in Jay Powell's interaction with the media. I think that to both the chair, Jay Powell, as well as the broader committee, that's something they have to take into account. The last time they met was back in March, before the April 2nd so-called Liberation Day, when President Trump announced a whole sweeping round of tariffs, both the 10% base tariff as well as the reciprocal tariffs, and of course the extra tariffs against China. And we've seen very volatile markets, both in the equity and fixed income and the currency market. And therefore, I think between the March meeting and where we are now, the Fed had a lot of things to consider. And again, they reiterated that if the tariff rate remains high, the risk for the US economy is for inflation to accelerate. Even though that may be a one-off, still we're likely to see high inflation and, of course, lower growth. And that was very much the message from the updated summer of economic projections back in March. So I think what we're seeing right now is that the Fed continues to see the both objective stretching in opposite and the wrong direction, with growth decelerating and inflation accelerating. And during the press meeting, he was asked a number of times, which one will he care more about? And also, are there any particular triggers that could see the Fed move into actually a rate cut mode? And frankly, Jay Powell was not ready to commit to any type of direction or any particular signposts when it comes to the US economy and subsequently in terms of monetary policy. He did mention, however, that if you look at the survey data, we have seen quite a significant deterioration in corporate sentiment as well as consumer sentiment. You can see on the left-hand chart, consumer expectations have come down quite a bit, really back all the way down to almost the sort of the post-COVID level. And at the same time, inflation expectation, where the scale, the right-hand scale on the left-hand chart is inverted, you can see that consumer inflation expectations have accelerated. Now, it's important to stress that sentiment doesn't have to translate into actual action, but our experience suggests that if cautious, conservative, negative sentiment persists for a long time, that could quite likely spill over into actual consumer spending. On the right-hand side of business confidence, again, you see quite a sharp deterioration from CEO confidence of current business conditions. If you look at a lot of the Q1 earnings results that came through in the last few weeks, many CEOs in their investors call did highlight the uncertainties, the risks to both margin pressure as well as the economy as a result of a lot of the tariff policies, alongside with a number of other policies that the Trump administration has been engaging in, for example, when it comes to cutting government spending. So I think all in all, the Fed is very much dealing with an environment where their objectives are moving, as I said, in opposite directions, but at the same time, in the wrong direction. So what does that mean? Well, I think, Jay Powell and co. very much stated that they're quite happy to be patient. They want to wait until there's some clearer signs of economic slowdown before they engage in rate cuts. And at the same time, don't forget, Powell and the Fed is under quite a bit of pressure from President Trump to cut rates. So I think as a way to demonstrate independence, first of all, the vote to keep rates unchanged was unanimous yesterday. That's, again, nothing controversial. But again, I think that partly reflects the unity of the FOMC to do the right thing based on economic data rather than political pressure. But at the same time, I could argue that the FOMC may need to see and get confirmation that the U.S. economy is really decelerating before they engage in rate cuts to avoid being seen as bowing down to political pressure. So again, you can argue that we may want to see further slowdown in the job market before they really engage in rate cuts. And the last Friday's non-farm payroll and the unemployment rate, non-farm payroll at plus 177,000 jobs created, and then unemployment rate staying at 4.2%. In Jay Powell's view, still pretty low and very close to full employment. That is not an environment that could push the Fed to cut rates anytime soon. So if you look at the futures markets or the OIS market, what you saw there is the probability of a rate cut in a June meeting has gone from 31% before the meeting, well, this time yesterday, versus 25% right now. And, if you look at the July meeting, which is towards the end of July, we're looking at around 80% of the chance of a 25 basis point cuts. And then between now and the end of the year, the market's pricing in 25 basis point cuts, between now and the end of 2025, which I think is a reasonable assumption. But even the July rate cuts, I think we need to see an ongoing deterioration in the job market for the Fed to pull the trigger in July. Another point to note why July is interesting for two reasons. One is obviously the reciprocal tariff was delayed for 90 days. And, we should start to see more trade negotiation, potentially high-level framework of trade deals starting to come through in the next few weeks. And that will give us some certainty of what the U.S. government wants and what the U.S. trade partners are willing to offer. So that's the first thing. The second thing is Treasury Secretary Steve Basson did mention that he wants to push through a budget bill by 4th of July. Of course, this will require a lot of negotiation with the Congress. Whether that would happen or not remains to be seen. But again, it seems like that early July is a really big signpost of potential policy shift. If, for example, trade negotiation, frankly, you can't negotiate with every trade partner between now and early July. You can negotiate with some of the biggest trade partners like Europe, like Japan, like South Korea, like India. China could be starting the negotiation with the US this week in Switzerland, at least to start to de-escalate some of the trade tension. So between now and early July, frankly, there's not a lot of time. You're not going to get every country striking a trade deal with the US. What happens then? When that 90-day postponement lapses, do the reciprocal tariffs kick back into action, or could that be delayed or postponed further down the road? So I think, the Fed has plenty of reasons to wait until at least the July meeting. But as I said, if the job number continues to remain solid, at least, let's say, 100,000 jobs a month created, or 120 jobs created every month, 120,000 jobs created every month, then the Fed may say, well, the economy actually, the hard data is still pretty robust. I've got no reason or no hurry to cut rates at this point. I'm still have to take care of the inflation part. So I think the risk is that the Fed may want to wait even beyond the July meeting. So let's watch that space. But I would argue that the next move from the Fed is still very much a rate cut. I suspect it's going to come sometime in the third quarter. So that's very much the Fed's view. And I just want to address some of the questions we've been asked a lot in the past few weeks on the back of the market volatilities in equities, fixed income, as well as in the currency market. I think the first thing to take into account is it's quite astonishing that when you look at S&P 500, where we are now, we are pretty much back to the or the days before the announcement of the reciprocal tariff before Liberation Day. So if you're telling me that the market's telling us that the US economy will continue to grow and expand as if the tariff announcement didn't matter, I would take quite a skeptical view. And while yes, we may have seen the absolute worst of the tariff policies as President Trump and team trying to walk back on some of those tariffs, but the reality is, I suspect, when all the majority of trade negotiations are done and dusted, we will still be living with a higher level of tariff rates compared to pre-April 2nd or President Trump's inauguration. At the moment, as a reminder, so when President Trump was inaugurated on Jan 20th, the average tariff rates on US consumer goods imports was around 2.4%. Right now, our estimates put it at around 22%, based on 2024 import data and the latest tariff numbers. So it's a massive step up, almost 10 times, when it comes to the increase in tariff rates. And let's say, US does manage to negotiate a sort of a ceasefire or truce with China. It managed to negotiate trade deals with its most important trade partners and bringing that tariff rate down. We could still be looking at 10 to 15%, which is still significantly higher than where we were at the start of the year. And in fact, if we look back to history, we're still probably much higher at that ultimate level compared to the past 50, 60, 70 years. So from that perspective, the impact on corporate earnings, on profit margin, on demand from US consumers, all of which could provide more pressure on US earnings. So if you look at on the screen right now, on the left-hand chart, as of a couple of days ago, market consensus for US 2025 or S&P 500 2025 earnings growth, it's still at around 9%. That to me is a pretty good number. It's a pretty robust number, because if you look at the next page, on page 6 of today's deck, look at the left-hand side, historically, really in the last 20, 25 years, the average EPS growth in the US is around 7%. So if you're telling me that this year and next year, EPS growth is going to be faster than the long-term average over the cycle, I would argue that's pretty optimistic, because you are seeing growth deceleration as well as profit margin compression. Because again, on the right-hand side, the profit margin in the US right now is at a pretty high level, and I suspect tariffs and associated rising costs could put more pressure on US companies. So I think the reality is, the earnings forecast as of now for the US continues to be relatively optimistic, and that could be a trigger for some correction in the markets in the medium or near to medium term. But just coming back to earnings expectations, we have seen some downward revisions in US earnings forecasts. So again, coming back to the left-hand chart, 3 months ago, the market was expecting 12, 13%. That's now down to 9%. I suspect there's more room to be downgraded. But if you look at, for example, Europe, if you look at Asia ex-Japan, in fact, in the last 3 months, we've seen some modest upgrades in corporate earnings. So again, the reason why we've seen Europe and Asia and some emerging markets outperforming the US in the recent past, I think there are a couple of reasons. One, the evaluation and starting point, obviously the US was more expensive compared to Europe, compared to Asia and emerging markets. And secondly, at least the earnings outlook, there's more room for disappointment from US perspective compared with Europe as well as APAC. So again, front running a little bit of our investment implications on equities, we do think that diversification can play a really important role in asset allocation in 2025 and arguably in 2026 because of the macro challenges that the US economy could face coming from tariffs, coming from government spending cutbacks, alongside with a number of other policies that the Trump administration is putting through right now. And then, if I look at the fixed income world, I do think that fixed income and income theme continues to be really critical. So, for example, if I look at investment grade corporate bonds, spread did widen a tiny bit in April, but overall we feel quite comfortable about the quality of investment grade corporate debt in the US as well as globally, which means you are effectively getting about 100 basis points in terms of spreads on top of your risk-free rates. That to me will hit somewhere between 450 to 500 basis points in terms of all-in yields. I think that's a reasonable level of yields for investors. And of course, for those who are a little bit more aggressive, if you look at, for example, high-yield corporate debt, again, corporate spreads is around 350 right now, no more than 400. It did expand a little bit in the month of April when the market was going through some corrections. But ultimately, I think default rates is likely to remain manageable, even if the U.S. economy does go through a bit of a slowdown, even a mild recession. So I think from that perspective, fixed income, whether it's in terms of corporate bonds, investment grade or high yields, even some of the emerging market fixed income, I think the income contribution would be really valuable to investors at a time when the stock market could be going through a bit more volatility. I think another couple of questions that we've been asked a lot is, should Asian investors be looking at cash as a way to just sit through the volatilities? And as usual, our answer is no, because if you look back to the last 10 years, where cash did outperform is really when you have a very, very high inflation problem, and that inflation is driven by both demand side and supply side. Right now, we could have an inflation problem on hand in the US, where supply side problems coming from policies, coming from tariffs, is pushing US prices higher. But at the same time, if you think elsewhere, in Europe, in China, in Asia, if demand from the US is coming down, export growth is going to decelerate. What you could see is actually weaker demand growth in other parts of the world, and that could be not necessarily deflationary, but disinflationary. So what you can see here is the Fed or the US facing a number of inflation challenges coming from tariff policies. The rest of the world, because of the slower trade growth, they may face a slower inflation, and that facilitate central banks to cut rates like the ECB, like the Bank of England. We had the People's Bank of China cutting rate yesterday, and we have a number of Asian central banks indicating they can cut rates a little bit more, like the Central Bank of the Philippines, again, yesterday talking about they have another 75 basis points of rate cuts to come, or room for that to happen. So all in all, I think it does create quite an interesting environment for fixed income, where a globally diversified fixed income can potentially benefit from central banks outside of the US looking to cut rates a bit more aggressively compared to the Federal Reserve. In terms of duration, personally, I would still stick with the short to neutral duration for a couple of reasons. Of course, if we're expecting weaker growth, what that means is bond yields is going to come down, the yield curve is going to shift down, and intuitively you want to be long duration. My challenge with that is two things. One is, we don't know what the US fiscal package would look like, how aggressive it would be in terms of cutting or maintaining fiscal deficits. Because it doesn't look like there's a lot of desire to raise revenue. Clearly, there's a lot of desire to cut expenditure, but as we've seen with with DOGE, that's actually very, very difficult without actually impacting of the standard of service provided to the general public. I mean, aviation safety is the latest example. And at the same time, it seems like that President Trump and the Republicans are quite keen to extend some tax cuts again to offer to voters as they start to prepare for midterm elections in 2026. So I think the potential supply of treasuries over the medium term could be a concern, especially for the longer end. And of course, there are a number of other factors. For example, if you look at, again, President Trump's relationship with the courts, with universities, I think there's a lot of questions about, whether, a lot of the fundamental drivers of the prosperity of the U.S. could be under challenge. And again, more of that could be reflected in the longer end rather than the shorter end. So from that perspective, I do recognize that, the longer end of the yield curve do offer, again, about 40 to 50 basis points of pickup compared to the shorter end. But at the same time, I do want to manage the duration risks a little bit more prudently, given the uncertainties coming out from the White House. The other point I want to bring up is about cash investments I mentioned earlier. The two charts that we have here is that let's push the scenario to a bit more extreme where the US economy does go into a recession. Now, first of all, it's important to stress that I'm not expecting a sharp recession like 2008 or 2000, because corporate and household balance sheets are in reasonably good shape, and there's no obvious misalignment in valuations. We've seen stocks valuation come down, but I would argue that's a fairly orderly correction so far. So from that perspective, we're not facing any imminent bubbles or financial system risks. As a result, the recessions that we may see later in the year because of corporate cutbacks, that could be more of a gentle slowdown rather than a sharp, aggressive, hard recession. Nonetheless, let's just push that argument a little bit and see what happens during a recession. And what we've done here on the left-hand side is to look at asset return 6 months after the start of recession, being defined by the National Bureau of Economic Research. And not surprisingly, you see equities have a tougher time. If you look at the far left-hand side of the left-hand chart, global equities down 20% in the first 6 months of the recession, and likewise for Asian equities. So from that perspective, no surprise there. A recession means corporate earnings recessions and cutback that naturally impact on equity prices. But if you look at the right-hand side, so this is the subsequent 6 months. So 6 months after the initial 6 months, so really month 7 to month 12, what you see here is that equities, except for the 2008 GFC, equity makes really strong rebound. So what we're seeing here is if investors are holding on to cash, if it's cash as in like current account cash, you don't get any interests, which means you're losing to inflation. If you're putting it in time deposits, right now a dollar deposit probably yield around 3.5%, maybe 4%, if you lock it up for 6 to 12 months. But the problem is, if you lock it up for 6 to 12 months, the risk is you may not be able to participate in the upturn. When the recession comes, okay, the initial phase, you might feel quite good about it. I've kept it safe. I've avoided the mark-to-market downturn. But that also means when the upturn comes, when the Fed start to cut rates, when the government start to, inject more fiscal stimulus, the economy and the market start to turn up, you may not be able to get out of that time deposits in time to invest in the equities. So from that perspective, I think short duration fixed income is a much better alternatives compared to time deposits, because you still get that level of interest to fight inflation or to beat inflation. Number two, if the economy is indeed going into recession and the Fed, other central banks have to cut rates more aggressively, you're likely to see bond yields come down and your bond price goes up. So you get a capital gain alongside with your interest. And of course, when the economy start to improve and bottom out, you have that flexibility, that liquidity to get out of fixed income and get into equities. So I think overall, the case for holding too much cash, in my view, continues to be a very weak one. All right, finally, two other popular questions. One is on the dollar. We've seen the dollar index down about 10% since middle of January. Last night, the dollar dipped down a little bit. I think, the fact that the Fed's able to act independently, that may have provided some confidence on the dollar. Now, the reality is, I think, a couple of things. One is the Trump administration is quite clear that I think they're okay to see the dollar getting weaker. The argument is the dollar's been too strong for a whole host of reasons, and that undermined U.S. export competitiveness. That's the first point. The second point is the U.S. continues to run a large current account and fiscal deficits, so twin deficits. And for any other currencies, what you normally see is when any economy is running that type of twin deficits, the currency depreciates, hopefully to rebalance those two accounts, the fiscal and the current account. But that hasn't happened in the US, partly because the US is such a hugely used currency for international transactions, for global trade. And as a result, the dollar has been artificially propped up by that type of transactions. Now, of course, the question of again, policy credibility coming from the White House, that may have undermined confidence on the dollar to some extent. But I think it's important to separate the value of the dollar and the role of the dollar. Because if you look at page 13 on the chart right now, the orange line, the dollar index, we're now 99.95 as of last night. So let's say 100. But if you go back to the period of 2003 all the way to 2013-14, the dollar was actually much weaker. The dollar index was around 80. And back then, no one questioned the role of the dollar. So it's important to separate the value of the dollar strength and weakness of US dollar exchange rates versus the strength and weakness of the dollar as a global currency. Now, again, you could question and doubt or being skeptical on the Trump administration and its policy execution, but the reality is the US dollar continues to be the most used currency in global FX transactions. So over 80% of global FX transactions has dollar as one of the two legs. In terms of global foreign exchange reserve holdings, again, the dollar owns or dollar assets is over 50%. If you look at bond issuance, foreign currency bond issuance, dollar continues to be extremely dominant in global trade, especially if we take out the intra-European trade, obviously that uses euro, the dollar's role continues to be very dominant. So what you have here is, the analogy often used is a messaging app. For example, in Hong Kong, we use WhatsApp. In China, they use WeChat. In Taiwan, they use Line. In the US, maybe iMessage. Apple is very dominant. And frankly, it depends on your friends and family and who uses what. Even though the messaging app may not be the best or the most advanced, as long as your friends and family uses it, it's very difficult, or no one's going to be proactively switching away unless there's a major security breach or the service terminated. And in some ways, the US dollar is very similar. It's because everyone's been using it for so long. It is the most efficient with the deepest liquidity in the markets, and arguably the most cost-effective with the tighter spreads when it comes to quoting an FX transactions. All of that will prolong the role of the dollar in the global economy. So unless something seriously breaks in the US, which I don't think is going to happen anytime soon, the role of the dollar in global financial transactions is likely to remain. Again, the share of it may gradually come down to some extent, but we're not going to see that being replaced by the euro or the yen or the renminbi anytime soon. So I think we've got to be very clear that we do expect the dollar to weaken a little bit more from where we are now for a whole host of reasons, but the role of the dollar in global financial system and global transactions is likely to remain. On gold, $3,500 per ounce. That was the record high back in the second half of April. And we think it's probably going to be a bit of a consolidation as of now. Partly the risk aversion has calmed down. And also the truth is, we could be looking at, an environment where investors, they want to diversify their portfolio. And again, gold as a component of portfolio construction, I think a couple of things. One is people think is a hedge against geopolitical uncertainties, and to some extent is a hedge against poor discipline, because the supply of gold is to some extent finite. Whereas, if you don't believe in a particular government or central bank, they could print money indefinitely, they could print money to fund their spending, and that creates a lot of anxiety. Gold, the amount is largely fixed. Its expansion is as fast as people can dig it up from the ground. But at the same time, it's important to recognize two things. One is that the gold price volatility is high. It's as high as some of the emerging market equities. So from that perspective, if you're trying to reduce volatility in your portfolio, gold may not be the best asset unless it has a very strong negative correlation with risk assets. And frankly, that's not super clear either. That's the first thing. The second thing is, we do think income plays a really important role in asset allocation for the rest of 2025. And as you know, gold does not provide any income from that angle. So essentially, you are taking quite a volatile assets with no income and trying to use that as a hedge against market volatilities. And that doesn't work out all the time. Obviously, in the last couple of years, again, you see on the chart here, since 2023, that has worked to some extent. But the reality is, as prices gets higher, I do think that the hedging properties of gold may not be as obvious as we've seen in the last couple of years. Sure, in the longer run, central banks still want to diversify their foreign exchange reserves. They may want to buy more gold. Consumers in China, in India, both as an investment asset as well as a consumer item, demand to continue to grow. But I think we may go through a bit of a consolidation when it comes to gold price in the near term. So yeah, it's pretty worth a part of your portfolio in there, but to me, it's starting to look a little speculative in nature of owning gold. You want to make money rather than you're investing in gold as a hedge against your asset allocation or your asset portfolio volatility. So just to wrap up everything, a couple of things. One, we think the Fed, the next move is still rate cut, but they have a lot of reasons to wait. Partly because the economic data is still showing decent strength in the economy. We are seeing weakness in sentiment survey data. They're not being reflected in hard data, especially job numbers just yet. And also, to some extent, they want to demonstrate their independence. They don't want to be told what to do. They want to base their decisions on actual economic data rather than political pressure. So that may also sort of raise the threshold of rate cuts when it comes to what kind of data they're looking at. Number two, in terms of asset allocation, we think that the global economy have sufficient resilience to remain in a growth mode, but growth is likely to decelerate because of the tariffs and also policy uncertainties coming out from the White House, which means that in terms of equity allocation, we do advocate a more diverse, globally diversified allocation. It doesn't mean that you need to sell the US, but I think active selection in the US market continues to be really critical. For example, we've seen a rebound in technology. I think a lot of retail investors took the correction in April and sort of added US tech. That to us makes some sense because US tech in the long run continues to be, I think, in a very positive trajectory. But at the same time, for other sectors, especially those who are vulnerable to imports of goods, they may still face a tougher time as the negotiation between China and the US becoming long drawn out, or US with other trade partners becoming long drawn out. And that to me could create more pressure in some sectors in the US. So the question is, we should be looking for high quality companies with strong pricing power or with a more service oriented revenue tilt. For example, if you look at the tech names, now I can't name names, but if you think about those tech names that sell phones, they've had a tougher time because they have to deal with a lot of tariff uncertainties, whereas social media or tech services, they have less of an exposure to tariffs, and they continue to invest in AI, and that you've seen that being reflected through their earnings results. So even within technology, there's still a room for active management to look for companies that will be more resilient in the tariff uncertainties as well as policy uncertainties coming from Washington. Fixed income plays a key role. We think that at least for now, short to medium duration makes sense because of the uncertainties of fiscal expansion in the U.S. And again, policy uncertainties coming out from the White House that arguably could allow or could make the longer end of the yield curve a bit more volatile. But on corporate credits, investment grade, high yield, depending on your risk appetite, we think that the corporate credit spreads, albeit is quite tight, it's a reasonable way to generate income. And of course, on top of that, there are other ways to generate income, whether it's from alternatives, things like infrastructure and transportation. Despite what's happening in terms of the tariff war, we've seen shipping rates come down between Shanghai and Los Angeles, but at the same time, shipping rates from Vietnam to the US has gone up. So I think that all in all, what you could see here is, again, a realignment of shipping and logistics that could create opportunities. Ultimately, as global supply chain becomes more complicated, you are going to need more shipping capacity as a particular product may have to make more stops along the way. And of course, in addition to that, option premium strategies where you could be looking to sell an option. You may sacrifice some of the upside, for example, in US equities or Asian equities, but that equity premium or option premium can be quite attractive at a time when, again, market volatility is high. And I think you could be quite happy to sacrifice some of the potential upside to equity markets while translating that into options premium. So I think there are many ways to generate income in this time. So, reach out to your salespeople at JP Morgan Asset Management to discuss potential solutions. Thank you so much for joining us. Our next conference is going to be the June FOMC meeting where my boss, Dr. David Kelly, is going to join us to talk about his view on the US, his interpretation of the Federal Reserve, what they're going to do. Maybe, a July cut's going to come. Who knows? So join us then. And meanwhile, if you have any questions for myself, for my team, for our investment teams, feel free to reach out your client advisors at JP Morgan Asset Management. And thank you again and have a great week ahead. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.